Okay. Good morning, everybody. This is the live market open for Wednesday, March 9th. I'm Yohay Elam of Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Sorry about the problems with the chat yesterday. Now we're back, and of course, that's a significant part of the show. We're one day ahead of the Draghi show. Speaking about shows. Okay, so today we'll talk as usual about the recent developments in markets. The mood is a bit more gloomy. Various charts and levels the next 24 hours, in which we have other rate decisions as well. And of course, your questions as aforementioned. Okay, good morning, everybody. Good morning, Jake, Fabiana, Dinda, Forex, everybody. All right, so as usual, we'll start with the market mood, and it isn't that good, right? So Chinese trade balance, we talked about that yesterday. It came worse than expected. Most importantly, significant fall in exports, 25% year over year, double the expectations. It had dampening market mood yesterday and throughout the session, and also today. In addition, we had Carney's testimony, where Carney, governor of the Bank of England, talked about, well, he did show his preference for the Remain camp. He does not want to Brexit. Good morning, everybody. We had a slump in oil from the highs. We'll show that. And in political news from the United States, always a fascinating story. I think the picture has become a bit more complicated for the establishment. More victories for Donald Trump on the Republican side. And Bernie Sanders on the Democratic side managed to win Michigan. I think Clinton still leads there, but the race is a bit more open than previously thought. So that's also, I guess, these two developments, political developments, are not what markets wanted to see. Okay, so let's move to the charts. As usual, starting with euro dollar, we've seen yesterday an attempt to move to the upside. We stopped before the resistance line of 110.70, and now we're back down, currently finding support at the old line, or what used to be the old line of 109.60. It's reestablishing itself. In any case, we're under 110. We've seen euro dollar slide from the highs during the US session and also the European session. And one of the things, of course, driving down the euro is expectations for tomorrow's ECB meeting. We did long previews yesterday, and on Monday, don't know if we'll do another long one today, but of course, we'll do one tomorrow, and there's a live broadcast. Let me take the opportunity to invite you all to a live broadcast by Valeria Bednarik, Dale Pinkert, Mauricio Carrillo, and myself tomorrow, beginning from 15 minutes before the announcement. That's 12:30 GMT. There's, first of all, an announcement at 12:45 GMT, and then the press conference by Mario Draghi at 1:30 GMT. Comment here, Germany Banking Association telling German banks to hoard cash. I wonder why. Could it be Deutsche Bank? The 65 trillion derivatives book. I don't know the specifics about Deutsche Bank, but the European banks have never fully recovered from the financial crisis. The situation there is not too great. We know about Deutsche Bank's exposure to commodities. Some of it has been overblown, but it's always an ongoing problem. Let's continue to pound dollar. We've seen it slide from the highs. Look how 142.30 is working quite nicely here as a line of resistance now. We made a move above this line when the mood was better early in the week on Monday, and then we had this gradual slide. Currently under 142, sorry. 141.25 still works as support, 142.30 as resistance. Okay, we have an important event today in the UK. Let's jump to that. Let's mark the screen here. So at 9:30 GMT, 10:30 European Central European time. It's the time you're seeing on my screen. We have industrial output and manufacturing output production, doesn't matter how you want to call it, from the United Kingdom. As always, we have four figures. We have the month over month in manufacturing and the year over year, and the same thing for industrial output. All in all, on the monthly level, we're expecting small rises, 0.2 in manufacturing production after a fall of the same scale last month, and an industrial production rise of 0.5 after a fall of 1.1. We know that the situation in the manufacturing sector is not that great. Year over year, we're expecting a small rise of only 0.2 in industrial output and manufacturing a drop of 0.7. Okay, as we've seen last week with as we've seen last week with the UK figures, they do have an impact. They have an impact before the release. Okay, that means we usually see the markets sort of adjusting to the data before expectations. Let's say we have the pound rising towards the release because they're expecting a good figure, or the pound sliding, something we've seen more last week, and then when the actual data comes out, it doesn't really it's sort of a buy the rumor, sell the fact, and we still have a reaction. But I guess about half an hour after the release, it's all gone. It's back to risk on, risk off, market mood, rumors, expectations for Brexit and things like that. So if you are trading around this release, it will have an impact, but remember that it won't stay too long. Will not be a game changer. Okay. Question here: is trading risk on, risk off? How do you know that every morning? Well, I look at several things. First of all, I follow markets quite closely. Basic things to watch. For the European morning, in many cases, it's the what happened during the night in Asia, especially the Nikkei in Tokyo and the Shanghai index in China, of course. What European stock markets open, but perhaps more importantly for Forex, it's always oil prices. Okay, oil prices, if they're going up, it's a good mood. If they're going down, it's a bad mood. Then, of course, it's also everything is related to the news. So we still have ongoing talk in markets about this Chinese trade balance, for example. That's risk off, and that's a different mood from what we had on Friday, for example, more risk on, because we had the perfect match for markets rising. More jobs in the United States, but inflationary pressures remain low. That means that the Fed will not hike, but the economy is doing well. Everybody partied all the weekend. Okay, I didn't know about specific parties, but things were looking quite good. Okay, so to follow markets. Anyway, let's continue. We talked about the euro dollar. We talked about the pound. This morning is very minor, and during this first hour of since we began the show, pound dollar is sliding, euro dollar is also sliding, dollar yen is also sliding. Now dollar yen goes the other direction. When the yen strengthens, that's risk off. Okay, that's another thing to look at. The yen is the #1 safe haven currency. That means when things are doing well, nobody wants the yen. When things are getting worse, the yen is in high demand. Look at it as, struggling to the downside. Perhaps we can add another line here at 112.40. Well, let's wait with that. Anyway, we're seeing a deterioration in dollar yen. That means stronger yen means more risk off. What are the Shanghai Nikkei names to put in the trading view to see the charts? I don't know about that. Let me say I don't follow. Here we are. Okay, so we have the Nikkei is I only have it on daily, but anyway, it's the NKY. Okay, Nikkei 225 stock index, and I think the Shanghai one is. I think it's that, but I'm not sure. Well, I use it just to read the news. Yeah, I think it's this one. Okay. Anyway, it's not something you should follow on a minute-by-minute basis. Just be aware. Of what's going on. Another comment here, before we move to other currencies, is UK's Queen is not amused as tabloids claim she is a Brexit fan. How the tabloids try to shape the population's minds, bidding the UK stay in Europe. Yeah, we had this report of one of the tabloids, I don't remember if it was The Sun or one of the other ones, saying that the Queen supports a Brexit, she doesn't like Europe, and that she said it in a conversation with a former leader of the Liberal Democrats, the third party in the UK, Nick Clegg. He totally denied it. He said he doesn't remember anything like that, and if she would have said something like that, he would certainly have remembered. They don't know where they take the information from. The Buckingham Palace released a statement that the Queen remains neutral. The Queen is a popular figure, of course, in the UK. She has no sort of official political power, but her words do have an impact. I don't think she weighed in the conversation. Anyway, it's part of the game, part of the information and misinformation. I also think that eventually Brits will decide to stay in the EU, just on the basis of better stay with the devil you know than leave. But they do have reasons to leave. They do have reasons to be angry with the EU. But I think the solution, for a small majority, is to fix things from within, or suffer the trouble within, because that means staying in the single market. Otherwise, you're only accepting the rules decided by others. Anyway, of course, it's a big argument in the UK press. Well, opinion polls are currently tight, and the referendum is on June 23rd. Okay. Another comment here. Well, I showed you about the Nikkei and the SSC, Shanghai. Anyway, let's continue. So we talked about euro, pound, yen. Let's continue to the Canadian dollar. Canadian dollar is one more leg higher, currently at 134.14, under resistance here at 134.60. This doesn't look like a strong line of resistance, right? But if we just look back, if we zoom out to the 4-hour chart, even, for example, we can see this 134.60 was a double top in late 2015. That's why I still look at this line as an important line. We had a break under it, back under it. Now it works as resistance. Dollar CAD fell to a low of almost, around 132.60 when oil prices were higher. And now when they're falling, look, they consolidated on low ground, moved up above 133 to 133.70, and now another leg higher to the 133.70 to 134.70 range. Okay, let's jump to oil prices. Same thing goes here. The line of 36 works as support. We already crossed 38, and that's WTI crude oil, West Texas Intermediate. On the other index, on the Brent one, the one more relevant for Europe, we already crossed the 40 line, and then we're back under this line. Okay, so that's where we are with oil prices. Worse mood in markets, less demand from China, expected less demand from China. Even though US production is a bit down, then we have a correction in this rally, in this big recovery. We're still more than $10 off the lows, okay? We reached $26 in mid-February, and we're off the lows. That's, at the peak, it was a recovery worth around 40%. So anyway, we're currently 36, between 36 and 37 and 38. Well, round numbers work here. Further support, well, also around number 35, perhaps 34.80. Okay, WTI crude oil. Let's go back. See, of course, everything's correlated to the Canadian dollar, but indirectly also to the Australian dollar. Now, the Australian dollar showed a lot of strength last week and also this week. Okay, currently it's 74.50. This old line of 74.40. Well, it worked once as resistance, but now it's a bit shattered. Anyway, 75 remains resistance, and perhaps we should update the charts. But no, let's wait. 74, perhaps some support before 73.75. We had some minor news from Australia overnight. Yeah, we had home loans missing expectations falling nearly 4%, worse than 2.3 expected. And investment lending, oh, it's the same figure. Oh, no, it's something else. It fell 1.5%. Of course, it's a related figure. Anyway, I don't think it had much of an impact. It's more the Chinese depression and the ramifications of this miss on trade balance on exports and also imports. Anyway, I see this morning the Aussie is recovering just a bit. Remember, we had excellent GDP last week from Australia, retail sales, trade balance. Things look good in Australia if you don't look at China, but China is the #1 trade partner. Anyway, for now, it's a correction, it's a consolidation in high range, and I'm not sure where the next move will be. We can see here more or less a bottom, but perhaps lower highs on the hourly chart. Still looking for a new direction after the big rally. Kiwi dollar, 67.40, continuing its deterioration. This currency pair is a bit weaker. Today we have the rate decision in New Zealand. Also a rate decision in Canada. I skipped that. We'll talk about all the events soon. 68.20 works as resistance, 67 as support. Worst mood in markets weighed on the Kiwi. Dollar Swiss, bang on parity, just flirting with parity as we speak, moving a bit higher. I suspect, as always, the S&B is intervening there. Anyway, 10040 more is further resistance and support at I would say 98.90 and 99. Anyway, it's a complicated currency pair. Euro Swiss is currently also on the move higher, 109.60. It found the bottom here at around 108 and 109.80, or perhaps a bit lower here. 109.70 is resistance. Follow-up question from Fabian actually meant, where do you follow them? As if you said, I look at the NetDania application on my telephone, on my mobile, and Bloomberg. It's basically available everywhere. It's one of the most known indexes. We're talking about the Nikkei and the Shanghai Composite. Okay, let's continue with Euro Pound. 77.40, not so strong anymore. Anyway, next support 76.60 and 78.50 is resistance. The pair is sliding just a bit, but basically looking for a new direction. The pound is suffering from Brexit talk, the euro from tomorrow's all-important rate decision. Okay, these are the lines to watch. Anyway, we're basically consolidating here. Euro yen is falling once again. Bad mood in markets. The yen is the ultimate #1 Ichiban safe haven currency. 123.34. 123 works as support, followed by 122.40 and 122 resistance. 125 and 125.50. Okay. Anyway, the euro is again waiting for Draghi, and the yen is sought. And when we have risk of atmosphere, okay. Sorry for that. Anyway, pound yen, the dragon. Last but not least on my usual round. Of course, any questions are welcome on other currency pairs. As always, the dragon is back under 160 due to the strength of the yen, due to the risk of atmosphere, the weaker pound, but also the stronger yen. We already reached a peak here, 162.30. Further resistance, 163.80. 160 now works as resistance, followed by 158.50 and 156.10. The bottom for the year has been 154.66. Okay. Let's see if I didn't miss any event from yesterday. They weren't that important. Canadian housing starts speed just a bit. Australian data, we talked about that. Remember, the mood works more than the data. I mean, when we're talking about second tier, third tier data points. Okay, today we have at 9:30 GMT UK industrial output. We talked about that. Should have an impact in the hour around, before and after the decision itself. At 3 GMT, we have the rate decision in Canada. Okay, what's going on in Canada apart from oil prices? Okay, we cannot avoid talking about oil prices. let's go back to the previous meeting of the Bank of Canada. They were rumored, they were expected to cut rates due to the fall in oil prices and the implications on the Canadian economy. The Canadian dollar was really, really weak towards that. We almost reached 147 on dollar CAD. They decided not to cut for two reasons. First of all, inflation is not that bad, and well, the exchange rate did help rebalance the economy in Canada. The second thing is that they were told by the government that the government is preparing a new fiscal stimulus plan. There's a new government in Canada led by Justin Trudeau. Perhaps you've seen his picture with the panda bears. It was all over the internet. Anyway, to more serious matters, in Ottawa, they're expected to announce a new budget, and the central bank is expecting that. When is the new budget due? During this month, during March. Okay, so that's why also now we're expecting another wait and see from the Bank of Canada. Since that meeting, dollar CAD is far stronger, over 1,200 pips. Dollar CAD much weaker. That means the Canadian dollar is much stronger. No changes expected, but they'll probably leave the door open to rate cuts. Since then, also oil prices managed to stabilize. Anyway, no changes expected, but a door will be left open to further moves. Employment was okay there. The economy in general is doing okay, and perhaps they'll have an influx of migrants from the United States if Trump is elected. That's just a joke, but we had searches about migrating to Canada leap after Super Tuesday. That's just a side note. Anyway, no changes expected, but of course, if they close the door on rate cuts, it's good for the Canadian dollar. If they leave the door open, it's much more likely then the Canadian dollar could fall. Regarding rates, they did say in the past that the bottom for rates is not zero. It's negative, like we have in Europe or Japan. It's minus 50 basis points. Currently, we're at plus 50 basis points. So let's see if they mention anything about that. Anyway, no changes expected. Very, very slim chance they will cut, because they have surprised in the past. In that case, the Canadian dollar will collapse, dollar CAD will rise. Well, very low chances. We'll probably wait a few more weeks for the next move by the government. Before we move to the next events, I see we have a question here on the Swiss franc against the yen. Not sure we talked about this currency pair in the past. If you're using TradingView, remember to move to the relevant tab there. Now you moved back to Forex. Wow, that's quite a fall on Swiss versus the yen. Naturally, the yen is stronger thanks to safe haven flows. Okay. We talked about that quite a lot. And the Swiss franc used to be a safe haven currency, okay, but doesn't work that way anymore because of all the interventions since back in September 2011. But luckily, we do have a nice technical behavior on Swiss yen. Okay, currently at 112.50, support 112.40. Yeah, so we're quite close to that. You can see this as a triple bottom here. On the top side, we have 115, also a round number, which worked as resistance just recently, and also here worked as support. So a very nice line as well. Further resistance 116.40. Okay, and here we are, and further support. Let's zoom out a bit. Okay, we'll have to go back to August and put a line right here. That's right. So it's 111.15. So if we lose this triple bottom here, there's lots of room to fall to the downside. Okay. All in all, the trend is to the downside, mostly because of the fact that the strengthening of the yen, the worst market mood in general in 2016. All right. Now let's go back to other events we have today. Remember, drug is the main event of the week, and that's tomorrow. But today we have a few more events. As we speak, euro dollar, well, still finding support at 109.60. So also at 3 GMT, together with the rate decision from Canada, we have an from in the think tank in the United Kingdom. Perhaps it's pronounced NISR, perhaps something else. They're estimating their GDP. It's a rolling 3-month thing. Last time it was 0.4. This time it's for the 3 months ending in February, so it's not a full quarter. Let's see if things deteriorate over there. You're most welcome, Duke. Second tier figure should be noted. We'll talk about that, mention that tomorrow, but not anything else. Crude oil inventories, of course, very important every week. This weekly circus. Let's see if we have, yeah. So last time we had a leap of over 10 million barrels in crude oil, and we had some other figures in distillates, gasoline, things like that. This time we're expecting a much more modest rise, still a rise, still more oil in inventories, still more oils to slosh around, just under 4 million barrels expected this time. Also worth watching here, it has an impact on all markets, of course. More oil is bad. That means less demand, more supply, worsening global economy, even though sometimes it's really supply related. Another thing to watch here, of course, is the distillates, and another thing is we might have also production levels. So if we see another fall in production in the United States, it could actually be good for oil prices, okay, and in general for markets. And yeah, unfortunately, we don't have that figure here on this calendar, neither on other calendars. So we'll just have to watch the news release if you're trading around that time. This is becoming more and more important, right? Let's continue. Well, at 8 GMT, we have a rate decision from New Zealand. I know many of you are shying away from this currency pair, but I'll still talk about it shortly. Don't worry. New Zealand situation, we have an interest rate level of 2.5%. That's the historic low. It's still above zero, above minus, above negative levels like we have in the Eurozone and Japan. Higher. So at the moment, no rate cut is expected. They were projected to continue cutting rates. They had actually from the middle of 2014 to they had this kind of rate hike cycle. They moved from 2.5 to 3.5, then cut it gradually back down. In recent months, they did leave the door they sort of said that we are neutral. No more rate cuts are expected, and they didn't change the rates for quite some time. They might not expected to cut rates, but might open the door for more cuts in the future because of the slowdown in China, because of the fall in milk prices. But if you look at the domestic economy, unemployment rate, GDP, things like that, the economy is not doing that bad. Next week, we'll have GDP from New Zealand. It's a very, very late figure. It's for the fourth quarter, and we're already towards the end of the first quarter. Doesn't matter. Anyway, we'll have a rate decision today. Watch the tone from Graham Wheeler, the governor of the Reserve Bank of New Zealand. Expected to be dovish, expected to complain about the strength of the Kiwi, and also leave the door open for interventions. We know that they intervened in the past. So markets are expecting some kind of dovish statement, but not a rate cut. Let's see how dovish they really go. In the past, they said that they would be happy with the lower value of the Kiwi, but not really worried about it. Maybe now with the recent rise, they could be a bit more worried, but I'm not sure. Anyway, markets are expecting a dovish sentiment. So if we have mildly dovish, leaving the door open for rate cuts somewhere later in the year, it's normal. But if they complain really seriously about the exchange rate, it's more dovish. And if they're sort of happy with the economy, it's bullish. So I think that everything is open. Markets again expecting something slightly dovish. Okay. Following up on the rate decision comes at 8 GMT in New Zealand, and then we have another public appearance by Graham Wheeler, the governor of the RBNZ. And at 1:30 we have Chinese inflation data. PPI has been negative for a long time. Producer prices, let me get that. See tomorrow. Let's begin with PPI. It's expected to rise from an annual fall of 5.3 to an annual fall of 4.9. But the consumer price index is expected to rise, well, that's month over month, more importantly, year over year. Expected to advance from 1.8 to 1.9. It's more or less within the targets of Western countries, around 2%. Let's see if we really advance as expected. It'll be some kind of relief, good news for markets. If inflation in China remains okay, at least consumer prices, not producer prices. But if it falls, if it disappoints, it sort of adds fuel to the fire after the miss on trade balance, especially on exports. Okay. I see here a question. Could you elaborate around last week's oil inventories and why oil price eventually rose? Yeah, let's mention that. Last week we did have a big jump in oil inventories, in crude oil inventories. They jumped 10 million. That was supposed to be bad news for oil, pushing it back down from the levels we've seen last week of around $34, back down towards 30 or even lower. But that didn't help. What was also released there is the level of production in the US. And there we've seen, finally, after a long time, some kind of a fall in production, okay? So we had lower prices for a long time, and production in Saudi Arabia, in Russia, and in the United States, and Canada, well, in general, remained quite high. We had this ongoing oversupply. As I mention every morning, too much oil sloshing around. The shale oil industry is a bit more flexible in the United States. That's good and bad, of course. And finally, after they weren't that flexible, they continued. They cut the number of rigs producing oil. We see that every Friday in the Baker Hughes report. But they cut out the fat. They cut out the worst performing ones, the inefficient ones, the ones that were expensive. And despite the fall in the number of rigs, we've seen production hold up quite well. Last week, we've seen production finally begin falling in this report by the Energy Agency. I don't remember the exact initials. There's so many agencies. Let me look at the name. But also on Friday, we had a bigger than expected fall in the rigs once again, after we've had very small falls in oil rigs. So this fall in oil rigs joined the Energy Information Administration, I got it now, report, and this supported oil. But there are also other forces in play. One of them is, of course, just the short squeeze. We had oil prices depressed. Everybody was short. When everybody's short, who's left to sell, right? So we had it also sort of a short squeeze, stop hunting, if you wish, and a rise back in oil prices. Let's see if it sustains. We have this report today, and we have a worse market mood than we had just 2 days ago, for example. Okay. Yeah, so that's where we are. Yeah, euro-dollar holding above this line. Okay, so we talked about all the events for today and yesterday and market mood. Any more questions? And of course, answered some questions. I'm glad we have questions. I'm glad the chat is back online. Yesterday, things didn't work out, and that was no fun. Had to talk on my own. Another thing going on in China this week is the People's Congress making their 5-year plans. Of course, they announced I see a question here. What should be with gold if risk off? Gold, I assume. When it's risk off, it's looking for safe haven assets. and gold is also one of them. So gold prices could rise on risk off. Not sure that's happening as we speak. I personally don't see gold as a hedge. Well, it's working the other way around, isn't it? So yeah, I must say I'm not following that too closely. We're clearly off the highs on gold. Gold enjoyed the non-farm payrolls report that showed well, the Federal Reserve is not about to hike anymore. I'm not so sure about this theory anymore. Anyway, let's look at rate hike expectations. Yeah, for March, no changes expected, even a small chance of a cut, according to bond markets. If we move forward, the next rate hike is expected, well, only in September. Okay. Anyway, the theory used to go, and I'll have to check it out. I don't have a clear-cut answer for you. Sorry. That gold, when things go bad, gold prices rise. No, but on the other hand, there's another theory that says when central banks are printing more money, then we have nowhere to fly to. Money is becoming worth less, and gold becomes attractive. So yeah, when central banks do less, gold becomes less attractive as money is worth more. With this risk on, risk off, so maybe I guess it's the other way around than I said. Sorry. With the NFP, we had a rise in gold prices. Now we have a fall. We had the bond king Gundlach talking about gold prices rising to 1,400. Well, we're a bit far from that, and this morning we're seeing a small slide in gold prices. Okay. Anyway, let me get back to you with a more detailed theory about gold prices, but in general, more money printed by banks, more value for gold, less value for money, paper money. Anyway, the lines to watch here are 1280 and 1250 at the moment, the current range. Okay, so I know it wasn't a full answer, but I hope this helps anyway. Big event tomorrow by the ECB. Talked about that quite a lot. It's the big event of the week. Let's talk about it once again. Basically, two tools for the ECB to do. First of all, a cut of the already negative deposit rate from minus 30 basis points to minus 40, or minus 50 or minus 60. The consensus at the moment is to minus 40. It's just 10 basis points. Something short of that would be a huge surprise and boost the euro. 10 basis points will be just the minimum, and it will also support the euro if it's done on its own, of course. So the first thing is the negative deposit rate. Between 10 to 30 basis points cuts is what we're expecting. I would say that 10 is sort of the minimum. Second thing is the level of QE. Here we have many options as well, but the main thing is the monthly buys. Currently it stands at 60 billion since the inception of the program, since it was announced back in January 2015 and implemented since March 2015. Expectations are from no change, remaining at 60 billion, to up to 90 billion, with the consensus more around, I guess, 70 billion. So consensus around 10 billion more per month and 10 basis points cut in the negative deposit rate. There are also a few details to watch there. For example, if they lower the negative deposit rate, will it be a two-tiered system, a three-tier system? How will it work? The mechanics, I don't think it's that important. I think the crude numbers are a bit more important. Regarding QE, of course, they extended it last time in December, 2 meetings ago, from September 2016 to March 2017. They could extend it to a later date or to forever, like the Fed did in theory, of course, with its own QE3 program, QE Infinity, until they decided to taper and cut it down and shut it down. And of course, they could also detail on which assets they buy. It could also make a difference. But remember, the ECB buys only bonds with yields higher than its negative deposit rate. So if German bonds that mature in, I don't know, 5 years, remember the numbers, they already have a negative yield of -30, they're not eligible for ECB buying. But if the barrier is lowered, it's a whole fresh bonds for the ECB to buy, more money in markets, and in the context of the previous question, more for gold. Big decision. Remember, we have live coverage of that, and it'll always be fascinating. Remember, with the ECB, we had the January 2015 reaction when Draghi and the ECB leaked some data, and then they over-delivered and the euro collapsed. And we have the December 2015 release when they created a big hype, lots of expectations and everything. And they just didn't do enough, and the euro jumped 460 pips in one day. Okay, so that's again a quick ECB forecast preview. Questionnaire of notes, the 20% jump in one day for iron ore. Yeah, that was today's Wednesday. That was on Monday. Since then, things changed. That was a good risk-on mood on Monday, supporting the Australian dollar, as you mentioned, and helping, of course, all the risk-on mood. We had headlines screaming that 20% jump. Since then, things have deteriorated. Okay, because of the Chinese trade balance on yesterday morning, about 30 hours ago, it still has a dampening impact on markets. Okay. Sorry. All right. Let's move to the wrap-up for today. So this is the wrap-up for the live market open for Wednesday, March 9th. The market mood is not so good because of what we had yesterday. Chinese trade balance still weighs, doesn't look good. A fall of 25% in exports. Fresh clouds over the global economy after the mood was already better thanks to the NFP and the short squeeze in iron ore prices. Answering your question. Also yesterday we had Carney testifying, supporting the Remain camp, basically, even though he tried to stay not political, and he said none of his statements are political, but of course everything is political in the real world. It didn't really impact the pound because it was not a surprise. Oil prices slumped again, blame China. In political news, things look more complicated for what markets want to see. That means Trump, the anti-establishment, won more victories in Mississippi and Michigan. Hillary Clinton, the establishment candidate on the Democratic Party, won Mississippi, but surprisingly lost to Sanders in Michigan. Still no real impact on markets, but something to watch. We have more primaries on the weekend and also next Tuesday. Let's look at currencies. Euro dollar is sliding in anticipation of the ECB support at 109.60, resistance still 110.70, further support 109 and 108.20, 107.70 and 107.10. I don't think we'll see huge movements today. We'll see more movements tomorrow, of course, with the ECB. We might have last-minute leaks, of course, but I don't think we'll get something new. I hopefully be surprised, but I don't expect that. Pound, we fell back to the previous range, 141.25 to 142.30. Expecting the manufacturing and industrial output at 10:30 European Central Time, 9:30 GMT. But I believe we'll have move the pound only in the half hour before the release and the half hour afterwards. After that, it will be market mood, Brexit talk, etc. Dollar yen, of course, weakening. The yen is strengthening thanks to the worsening mood in markets. 112.20 is support, but this is a very choppy pair. The line in the sand is the double bottom of 111. Okay, on dollar yen, 111, very strong line of support. 113.10 is some kind of resistance, followed by 114. Very choppy pair. Dollar CAD is on higher ground under previous resistance line, which also now works as resistance. 134.60, support at 133.70, of course, due to the fall in oil prices. Aussie dollar relatively holding its ground, even, well, as we speak, it's strengthening. We had it rise last week on great figures in Australia, and then weakening on this Chinese trade data, but holding up relatively strong. 73.75 to 75 is the wide range, and the Kiwi dollar ahead of the rate decision, a bit lower, 67.40, the range 67 to 68.20. Okay, events for today mentioned UK rate decision. UK industrial output, rate decision in Canada, and that answers the question for Jax regarding pairs to trade today. I think it's a Canadian dollar because of the rate decision, because of crude oil inventories, because it's looking for a new direction after finding a bottom. Let's see if it was just a correction within the range, within the trend, within the bigger trend of falling, or a change of direction. Everything depends, well, mostly on the Bank of Canada, but also on crude oil inventories. For the Canadian dollar, crude oil inventories affect the whole market, especially the level of production. Also worth mentioning just a bit, the UK needs their GDP estimate. More importantly, rate decision in New Zealand with follow-up testimony by Governor Wheeler, and more data from China. The inflation data has an impact on the Australian dollar. All in all, the focus today in the next 24 hours is clearly on commodity currencies, okay? And that will be over tomorrow morning, because we'll during the night, and then we'll begin talking once again, not for the first time. As promised, we'll talk all week about Draghi, of course, also afterwards. All right. So yeah, so that's the show for today. Thank you everybody for coming and for the really great questions. I hope we all learned something together, and wish everybody a safe and successful trading day. And we'll be here tomorrow explaining what we had in the rate decisions in Canada and New Zealand, and other events in crude oil, and of course a big preview for the ECB last minute adjustments. You can all just do small self-promotion and say that I have a page on Forex Crunch concentrating all the bank estimates, all the relevant information from the ECB, all the links you need to know. So that's it for today. Have a great day today. See you tomorrow. And that's it. Bye-bye.